Hey everyone, and welcome to This Explainer. Today we're going to completely tear down one of the greatest illusions in modern wealth creation. We are going to peel back the layers of the real estate industry to show you exactly how the most successful operators actually make and, sometimes spectacularly lose their money. If you've ever thought about getting into real estate, or even if you just like keeping an eye on the housing market, this is going to fundamentally change how you look at every single building around you.
So you've probably heard some version of this pitch, right? Buy property, collect rent, watch value climb, retire early. Just put money in, get more money out, and repeat until you're sipping something out of a coconut on a beach. It sounds so mechanical, doesn't it? Almost foolproof. And honestly, it totally makes sense why we want to believe it, because real estate genuinely has created stable generational wealth for decades. But there is a massive, fundamental part of this story that conveniently gets left out of all those easy money pitch decks. And that brings us to the reality check. The people who actually run real estate businesses at massive scale, I'm talking the big developers, the mega flippers, the institutional landlords, they aren't really in the property business at all. They are in the timing business. Once you wrap your head around that distinction, it literally unlocks the mystery of why some companies quietly compound wealth for generations, while others post record revenue one year and then just completely implode the next.
Okay, let's really break this down. When you strip away all the fancy branding, every single real estate business is essentially running one of two models. And sometimes they're running both at the same time. First, you have the visible spread model. This is the one everyone sees and gets. You acquire an asset for a certain price, and you extract more value from it than you paid, either by flipping it for a higher price or renting it out. But then there's the second model, hiding right beneath the surface, the timing model. Now, what's crucial to understand here is that real estate is spectacularly illiquid. You can't just sell an apartment complex in half a second on your phone like you can with a tech stock. So every operator is quietly making this high-stakes bet on how long they're going to be forced to hold that asset and what exactly will happen to their costs while they're holding it. Most everyday people only think about the spread. The actual professionals, they live and die by the timing.
But before either of those models can even get off the ground, you have to cross a massive barrier. We all know how leverage works, right? Real estate relies on ordinary people borrowing 4, 5, sometimes 10 times their own money just to buy the asset in the first place. And this is exactly what makes real estate returns look like a literal cheat code on paper. Think about it. If a property appreciates by just 10%, but you only put 20% down, your actual return on your own cash isn't 10%, it's closer to 50%. That right there is the alluring psychological trap that gets absolutely everybody so pumped up to jump in. But wait. Here is the giant catch. Leverage runs in both directions. It absolutely does not care which way the broader market is moving. If that exact same property drops 10% in value, the loss on your invested cash is a devastating 50%. And the debt? The debt doesn't care at all. That mortgage payment is just a relentless machine. It is due whether your tenant paid rent this month or not, and whether the market is up or down. This two-way street of leverage is the first quiet trap that can turn what should just be a mild market dip into a totally business-ending event.
So let's look at the rental model for a second, since that's what most of us picture when we hear passive income. When amateur investors look at a property, they almost always ask this one surface-level question. Is the building full? A 100-unit apartment building at 95% occupancy sounds amazing, right? On paper, it looks like it's thriving. Cash is rolling in. But honestly, occupancy is totally the wrong question. What it doesn't answer is the building profitable? Because an owner doesn't just pay a mortgage. They're on the hook for property taxes, insurance, property management fees, massive capital repairs like replacing a roof or an HVAC system, and, those inevitable 3 a.m. plumbing emergencies. Experienced operators actually plan for 40 to 50% of their gross rental income to just completely vanish into operating expenses before a single dime goes to paying off the debt. If rents are set too low compared to those creeping costs, a building can be 100% full and still be bleeding cash every single month. Okay, let's switch gears to the second huge strategy and see how this risk builds. Buying a place to renovate and resell, flipping, or at the massive institutional level, iBuying. This entire model relies on capturing the spread between the purchase price and the resale price. But look closely at the hidden trap in step 3. Renovation costs, super expensive short-term financing, agent commissions, closing costs, and the literal cost of holding the property during the renovation, all of that easily eats up 15 to 20% of the property's value before you even count your first dollar of profit. You aren't just casually buying low and selling high. You are desperately trying to beat a moving target that is eating away at your potential upside every single day.
And this brings us to what I think is the wildest, most counterintuitive discovery in this whole industry. The property itself rarely destroys a real estate business. A property doesn't have to lose a massive amount of value to bankrupt an operator. No, it just needs to sit there, unsold, unrented, for just slightly longer than your financial model planned for. Time is the absolute ultimate cost center. Every single extra month a property sits unsold is another month of interest, taxes, and utility bills draining your cash reserves, with zero revenue coming in to offset it. To really see how dangerous this timing risk is, let's look at a massive corporate case study. Back in 2019, Zillow expanded its Zillow Offers division. The pitch was super simple. They would use their mountain of data to buy your home for cash, do some light repairs, and capture the spread. Just look at this growth. In the third quarter of 2020, revenue was $186 million. By the third quarter of 2021, revenue exploded to $1.17 billion. That scale is just staggering. From the outside, it looked like absolute proof that their model was working perfectly. But here is where it goes off the rails. Growth in revenue and growth in hidden risk were happening at the exact same time. Here's the timeline of the collapse. In early 2021, their buying accelerated rapidly. Zillow actually doubled its exposure to these illiquid assets in just a 3-month window. But then, summer of 2021 hits, the red-hot pandemic housing market started to cool down, and Zillow's buying pace didn't slow down with it. Suddenly, they were holding thousands of homes they just couldn't resell fast enough at the prices they needed. By November 2021, they had to shut the entire division down, completely. They took a $540 million write-down and had to cut around 2,000 jobs. Over the entire life of that division, they lost more than $1 billion. What this shows us is absolutely crucial. Zillow wasn't some scrappy startup just guessing at home prices in the dark. They had proprietary algorithms, the famous Zestimate, literal teams of PhD economists, and access to more housing data than practically anyone in history. But when the market shifted and homes started taking 90 or 120 days to sell instead of 30, the spread just vanished. The carrying costs compounded, and the lesson became incredibly obvious. Once a spread becomes impossible to reliably predict, there is absolutely no amount of more data that can fix a broken timing assumption. Now, you might be thinking, well, maybe Zillow just mismanaged it, but they didn't. The entire iBuying category learned this exact same lesson. The biggest remaining iBuyer, Opendoor, ran into this identical pressure the very next year. As rising interest rates cooled off buyer demand, Opendoor actually sold homes at a loss on 42% of its transactions nationwide in August 2022. And it was even worse in certain markets. In Phoenix, for example, a staggering 76% of their sales that month were completely unprofitable. Literally 3 out of 4 houses sold at a loss. The mechanism of failure was exactly the same both times. Rapid acquisition growth, a sudden shift in the market, and inventory that simply couldn't be resold fast enough to beat the clock. And here's the thing. Whether you are a multi-billion-dollar Wall Street giant or a local crew trying to manage 3 flips at once, you are exposed to this exact same mechanism. Scale does not eliminate the timing risk. It literally only magnifies how catastrophic the explosion is when your timing assumption breaks. So, how do the real pros actually survive a full market cycle? Because let's be fair, the best case outcome of real estate is very real. It has produced durable wealth for generations. But surviving requires a discipline that is far less glamorous than the gurus make it sound. It requires immense patience. It requires massive cash reserves to float you through those brutal months where properties just sit empty. It demands a stubborn refusal to over-leverage yourself when the market is booming. And it requires intense, active cash management. True professionals know there is no such thing as magical passive income. This is an active, demanding business that just happens to use physical property as its product. All right, bringing it all together for this explainer, we have to fundamentally shift how we look at this asset class. The beautiful property in a great location, that's just the visible surface. Underneath it all, every single real estate business is actually a bet on time. How long can you afford to hold an illiquid asset before the market, your debt, or your carrying costs force your hand? The property is just the collateral. The clock is the actual risk that operators are managing, or completely mismanaging, every single day. So I want to leave you with one final thought to chew on. We've just seen that infinite data, endless piles of Wall Street capital, and the smartest pricing models on the planet couldn't outrun the carrying costs of an illiquid asset. The very next time you hear an easy money pitch promising guaranteed passive income in real estate, I want you to ask yourself, if the smartest algorithms in the world couldn't beat the clock, how confident are you in your own timing?
Thanks so much for joining me for this explainer. Keep learning, keep asking the hard questions, and I'll see you next